All right, let's jump right into this because we are looking at the ultimate 2026 energy paradox. Right now, the United States has completely solidified its position as the world's absolute #1 exporter of crude oil. We are pumping out a record-breaking 5.2 million barrels every single day. And yet, if you've driven anywhere recently, you know the brutal reality. Americans are paying record prices at the pump. So how on earth can we be swimming in exportable oil, while at the exact same time you're emptying your wallet just to fill up your car?
It's a fantastic question. And honestly, framing this disconnect correctly, that's where the real alpha is. It's incredibly tempting to look at this and just assume there's some massive geopolitical conspiracy or market manipulation at play. But the reality is actually a fascinating industrial mystery. What we're really dealing with here is a fundamental chemical mismatch. It's a structural lock-in that institutional investors and energy analysts deeply understand, but everyday retail consumers are completely blind to.
To anchor this with some hard data, let's look back at the spring of 2026, following those catastrophic supply disruptions in the Middle East, specifically the closure of the Strait of Hormuz. The global market was scrambling for oil. U.S. crude exports surged by 30%. We literally acted as the primary relief valve for the entire world. Yet global prices didn't ease up at all. In that exact same time frame, the global benchmark, Brent crude, saw its price surge anywhere from 89 to over 108%. We exported more than ever, and global prices still doubled.
So here is our roadmap to solve this mystery today. First, the export price paradox. Second, API gravity and chemistry. Third, the refinery complexity index gap. Fourth, margins and bottlenecks. Fifth, the retail USO trap. And finally, number 6, the permanent heavy reality.
All right, kicking things off with Section 1, the export price paradox. To truly grasp this, we need to set the scene in early 2026. A massive geopolitical crisis essentially removed roughly 20% of the world's seaborne crude oil from the global supply chain. The world desperately needed oil, and the U.S. stepped up. We hit that record 5.2 million barrels per day in exports. Our net imports plummeted to just 66,000 barrels a day. I mean, that is the slimmest margin we've seen since 2001. On paper, we were practically energy independent. But the U.S. retail gas average surged to $4.10 a gallon anyway. The brutal truth you should take away from this is that a localized domestic abundance of oil cannot insulate your local gas station from the global market risk premium. We are integrated into a global market, so we pay global prices.
Moving on to Section 2, API gravity and chemistry. The actual DNA evidence of our mystery comes down to physical chemistry. To understand this, we have to look at API gravity. This is a scale created by the American Petroleum Institute that basically measures how heavy or light petroleum is compared to water. It's pretty simple. If it's over 10, it floats, that's light crude. If it's under 10, it sinks, that's heavy crude. But it's not just about density, it's also about sulfur content. High sulfur makes oil sour, while low sulfur makes it sweet. Now, the U.S. shale revolution produces an absolute ocean of oil, but it is almost entirely light and sweet.
Let's compare the technical specs. Take U.S. pumped West Texas Intermediate, or WTI. With an API gravity around 40 and very low sulfur, it's premium light sweet stuff. Now compare that against Venezuela's Mary 16, or Western Canadian Select. These have massive sulfur content and incredibly low API gravity. They are heavy and they are highly sour. Now, heavy sour crude is physically thick. It's heavily corrosive to equipment because of the sulfur, and it generally produces much lower value end products. Think asphalt and industrial bunker fuels. It's incredibly hard to extract, and honestly, accessing it can be increasingly complicated geopolitically with sanctions and blockades. Because it's so difficult to work with, it trades at a massive discount on the global market. And you guys, that discount is the secret ingredient to understanding our entire problem. Which brings us to Section 3, the Refinery Complexity Index Gap. This index is the billion-dollar architectural lock-in that dictates exactly where our oil goes. To measure how sophisticated a refinery is, the industry uses the Nelson Complexity Index, or NCI. A simple boiling pot has an NCI of 1. The global average sits around 8-9. But the U.S. Gulf Coast? The average NCI there is a massive 11.5. Why? Well, back in the 70s and 80s, the world thought light sweet crude was running out. So U.S. refiners spent billions building massive, highly complex secondary cracking units. These were designed specifically to take that cheap, highly discounted, heavy sour sludge and forced it to turn into valuable gasoline. And that leads us straight into the trap, refinery misalignment.
We pumped all this beautiful, light, sweet oil out of Texas, right? But our massive, multi-billion-dollar refineries on the coast were completely customized to process heavy, sour sludge from Canada and South America. Trying to run our own domestic light, sweet crude through these complex coastal refineries, it's exactly like pouring premium unleaded gasoline into a heavy-duty diesel tractor engine. It is physically inefficient, and it leaves those expensive billion-dollar secondary processing units sitting there totally empty and underutilized. That absolutely ruins a refinery's profit margins.
All right, Part 4, Margins and Physical Bottlenecks. Because even when oil prices are skyrocketing, it absolutely doesn't mean everyone is making money. Look at the crack spread. That's the profit margin refiners make between buying the crude oil and selling the finished gasoline and diesel. In March 2026, the Brent crack spread hit an astronomical $42, while WTI was sitting around $30. But here's the catch. When the input cost of crude oil rises too fast, refiners simply cannot raise the price of gasoline at the pump fast enough to match it. This causes severe margin compression. So even with high oil prices, refiners can actually see their profitability squeezed incredibly tight.
On top of that, we have incredible physical constraints. Let's just say we wanted to ignore the chemistry and shove our domestic oil into our system anyway. We physically can't get it there. Despite a record 13.6 million barrels a day of domestic production, the pipelines connecting the Permian Basin to the massive export and refining hubs in Corpus Christi, like Gray Oak, Epic, and Cactus II, have been stuck at a 99% utilization rate. The pipes are literally full. There's absolutely zero room for incremental domestic movement.
Moving to Section 5, the Retail USO Trap.
This physical dynamic actually creates victims. When gas prices spike, everyday retail investors get angry and try to revenge buy the oil market to make their money back. And the most popular vehicle for this is the United States Oil Fund, ticker symbol USO. But this is where the retail investor, quite tragically, steps right into a massive mechanical bear trap. You see, USO does not hold physical barrels of oil in a warehouse. It holds financial futures contracts, and those contracts track the daily movements of WTI futures, not the physical spot prices refiners pay, and certainly not the retail gasoline prices you pay at the pump.
The trap is driven by the mechanics of something called contango drag. Step 1. USO buys oil futures that expire in 1 month. Step 2. As that month ends, the contract expires. Step 3. Since USO cannot take physical delivery of the oil, they must sell that expiring contract and roll into the next month's contract. But in a normal market structure called contango, the future month is always more expensive. So USO is mechanically forced to buy high and sell low every single month, guaranteeing a systematic loss of value over time, even if the headline price of oil stays high.
So who exactly is on the other side of that trade? Well, in 2026, retail sentiment on internet forums for USO was wildly bullish, sitting at an 85 out of 100. People thought a short squeeze was coming. But at the exact same time, institutional short volume spiked a massive 716%. Institutional players know the mechanics. They create new shares to capture arbitrage profits, which effectively caps the upside and mathematically prevents the short squeeze that retail investors are praying for.
Finally, Section 6, the permanent heavy reality.
This all leads to the obvious question. If this is such a headache, why don't we just retool our heavy refineries to process our own domestic light oil? Well, the brutal truth is that retooling these coastal mega refineries would cost billions of dollars and take several years of intense construction. But the ultimate deal breaker is the lifespan of our oil. Estimates show that U.S. light shale reserves only have about 11 years of high productivity inventory remaining. Spending billions to completely overhaul our infrastructure for a fuel source that is actively peaking, it's just a massive destruction of capital.
And that requires us to completely reframe our thinking. Energy security is not synonymous with low prices. This is the core takeaway. By exporting our light, sweet crude to countries that need it, and importing highly discounted heavy sour crude to feed our hyper-complex refineries, the U.S. refinery system remains the most profitable and efficient on the planet. It makes us an absolute industrial powerhouse. But as we've learned, it does absolutely nothing to lower your bill at the gas pump.
Which leaves us with this final thought. You now know the difference between the headline of energy independence and the chemical reality of API gravity and refinery alignment. As global energy reserves inevitably grow heavier, sourer, and much more volatile, you really have to ask yourself, is your portfolio built to chase the headline, or is it built for the physical reality? Thanks for joining me on this deep dive, and I'll catch you on the next explainer.